The truth is, sometimes we get comfortable with the ordinary, sitting inside the lines others have drawn for us, when there is an entire blank canvas of a world waiting for us to trust fall into solutions to questions not even asked yet, to rise, revise, and recognize that remarkable is not only possible, but it is necessary. It is the result of daring to imagine beyond this partition of parameters, always onwards, upwards, and forwards, towards the whys of ideas redefined, the what-ifs of partnerships, the how can we improve this. This is more than a common belief that in order to succeed, we must always see details 3 steps ahead. This is not about spotting market trends or hopping on bandwagons, because many others have been there, and quite frankly, so have we. But we are also about people. Shorooq, the right fit in the right place, like perfectly timed happenings matching skills with partners already found, where the sum of parts can create platforms only teamwork lets you reach. No, not you, us, plural, collective, a home field advantage, expertise meeting the opportunity of what we did, are doing, and will do, investing in holding open doors wide enough for impact to walk through. So we continue being the outlier, the deviation, the above and beyond expectation, the ones uncomfortable with being ordinary. Today is the day. Join Shorooq Partners.
Welcome everyone to our 5th episode of our weekly MENAP Venture Debt series, where every Tuesday at 3 p.m. GST, Shorooq Partners and IMM Investment Global go live on LinkedIn, Twitter, and YouTube, where we discuss venture debt and answer some of your questions, any of your questions you might have. If you're watching this through our LinkedIn, Twitter, or YouTube, remember to follow, subscribe, and click that bell icon to get notified with all our news, events, and updates. This show is brought to you by Shorooq Partners, the leading tech investor in the Middle East, North Africa, and Pakistan. And I'm your host, Tariq Fouad, Head of Growth at Shorooq Partners. And I want to thank you all for tuning in from wherever you are. Obviously, I would love to introduce you guys to Nathan Kwan, our senior investment professional and lead on the venture debt side. We are blessed to have Nathan lead our venture debt series. Thank you so much, Nathan, for joining us today.
Thank you, Tariq. It's a pleasure as always.
Awesome. So we've been over the past few series or few episodes been discussing venture debt across different verticals, from what a typical DD looks like, how is venture debt different from venture capital. We discussed how and when is the best time for venture capital and venture debt to be coexistent in a journey, in a startup journey. But I would like this episode to speak about securities a little bit more and to understand and to make sure that startups have the right mindset towards securities and to approach securities in a way that gives them the confidence to take on venture debt as they grow in with their startup. So maybe take us first of all with a recap on what securities are, who are we looking for what are we looking for when it comes to securities, and what is the best way for us to approach securities as a founder.
Thanks, Tico. So let's start with the basics. When you're taking on a loan, it is an obligation, right? So it is a type of a capital that you have an obligation to repay at the end. Now, but because of course, we cannot be sure about what's going to happen in the future, a loan would typically be underlied by an asset or a right of value that is there to support up the value of the loan that we're making. So securities could be anything from something tangible like property and equipment, the building, inventory, to a right to receive money, such as insurance proceeds, your receivables, your contracts with your clients. But basically, the idea is that there's something underlying the loan and that is supporting the loan so that the lender feels comfortable enough to provide that capital, and the borrower is able to take that capital without too much paying too much of a price on it, which would be your interest on the loan.
And I believe with such securities, maybe in your experience, you've seen a lot of founders questioning and finding maybe a bit of anxiety talking about these securities and the risks that could potentially come across, right? So maybe speak to us again here, and I think you've touched upon this last time we spoke, is that usually these are startups that can potentially pay through its own cash cycles, pay for the loan. And it's usually only when you default that some of these risks become apparent. So maybe speak to us again here. How does a founder ensure not to take this from to give it more than its need be, in a sense, and to have a better mindset towards that security, and how to make sure they have the right mindset towards it?
So I can understand that from a founder's perspective, or actually from anyone's perspective who's never taken out on a loan before. If you see that first, that word security, guarantee, it could be jarring and you could be scared. And that doesn't just go for kind of founders and companies raising it, but even if you're as an individual, if you've ever taken on a loan to buy a car, to buy a house, the idea of like putting something on mortgage, that is scary and it could be jarring. But really, I think the right way and the right attitude to approach this is think about what are you losing and then what are you gaining. So in terms of what are you losing, there's no effect on the company's day-to-day business if you provide security, because it is not hindering the company's assets. It is not providing placing any restrictions on the way business is done or the way the operations are done. Really, what security means is that when there's some time of a default, now, of course, we don't want to see that happen, nor do we expect it to happen. If we expect that to happen, we wouldn't be giving the loan in the first place. Yeah. But in an off-chance doomsday scenario that apocalypse comes, then it's simply the obligation to pay back the loan would already be there. But as a lender, we want there to be something of tangible value that is directly tied to the loan. So it's not adding any obligation. Just because you have security doesn't mean you need to pay less on the loan principal, or just because you don't have the security, you don't have to pay back the loan. It's not like that. The loan as an obligation is always there. If he lends you $1, you have to pay back the $1. What the security is really doing is that among the various kind of the assets that the company has, what is a specific thing that is kind of providing that dollar value. So it is not an additional obligation, and it is not something that hinders the day-to-day business of the company. So that's what I think that's what I really wanted to kind of demystify for all of you out there who might be wondering what is this and why is this being done. Now, it's kind of as a related point, what you should be caring more about is
hold that thought, Nathan. Hold that thought, Nathan. I would, because this is extremely, extremely important. And I think the reason why we keep on bringing about securities and the importance of how to deal with it and what does it mean is because from experience, we're seeing more and more founders questions all kind of center around securities. And that is why, I want to remind everybody seeing us today, tuning in live, put your questions down in the comment section. We want to answer them. Any questions, regardless of what it is around the venture debt topic, please, shoot them in the comment section. We'll make sure that we find the time right away to answer them. And if it's about securities, why not shoot them there as well? So then, we have a lot more to talk to you about specifically to your case. So thank you, everyone. Nathan, back to you. Please, that second point that you wanted to mention.
Thanks, Todd. So where was I? Yes. The point that you should care about, though, is whether the security or the guarantee being provided is personal or is corporate, is at the company level. So I know this is quite a bit of an established practice in the region, and I'm sure any of you who've actually been to a bank to take out a loan for the company, have experienced the bank or financial institution asking for a personal guarantee on the loan. Now, there's a reason that they do it, and I'm not saying that it's completely unfounded, but as an investment firm, as Shorooq, that is a practice we want to be staying away from. Because the whole idea of providing venture debt is that we want you to be able to grow the company without having to pull your personal assets at risk. So we try to stay away from any kind of a personal guarantee on the loan. And even if it is offered, we don't take that. And we do that as a principle because we always want to be looking out from the founder's perspective. And the idea isn't to recoup the loan at all costs. The idea is to provide capital that can help the company grow and the business expand. So if there's any kind of and not just with us, but if you're negotiating a loan package and if you're negotiating a debt, I'm not saying that necessarily is an immediate killer for the deal, but that is something you should be aware of, and that is something you should take into consideration. But as a Shorooq, as a firm, we do not do that as a principle. And what we try to do is to make sure that there is that corporate veil between the personal and the business.
Thank you so much, Nathan. Now, with regards to securities, and you said that mindset that you would like founders to actually have with regards to securities, maybe take us through, as a founder, I'm reaching out to Shorooq Partners to raise venture debt, right? Where does the conversation about securities start to happen? Does it happen at the beginning, or whereabouts in the DD process that this happens?
I think that's a very important point, Tariq. So because as an investor and also as people who talk business, we used to think that the security conversation should happen towards the back. It's not the most important part of the deal. Really, the most important part of an investment are the economics and the financial terms, right? And that's what usually the founders want to know the most about and are most interested in talking. So we always start there and take the deal forward from there. But in our experience, we realized that just because this is such an unfamiliar topic, and that when it comes to the time of the final documentation and you see these kind of provisions put in place, it could come as a shock. It could be jarring, and we understand that. And I think maybe perhaps our kind of the point that we overlooked was that although this is a legal point, in the end, it's all people who are making these deals. And in the end, there has to be a personal comfort and understanding toward what is being put on the table. So now we try to bring these conversations up front because we always want to be as transparent as possible. And we want to make sure all the parties involved know exactly what they're going into. Now, so in terms of process, we are trying to kind of bring that include the securities and the legal points conversation early on as much as economics. Now, the another thing you mentioned was the mindset. What is the right mindset to approach this? And I think the right mindset to have in this case is whatever that is being offered as a security, you're basically utilizing assets that was lying dormant in your balance sheet, that was lying dormant in your company to raise capital. Now, in terms of when it comes to equity, always the asset, or rather the resource that is being provided to raise the capital, is your cap table. And the cap table is one of those things that you can't really go out and just sell a cap table in the market. It's not like a service or a product. So it is an excellent and definitely something you should utilize in order to raise capital. Now, what all of these other securities do is that in addition to emerging startup, non-profitable companies cap table, it adds a couple additional resources for you to go out and raise alternative means of capital. So that could be the shares that you have in the company, share pledges, that could be the receivables you have, that could be the contracts that you have with certain clients. So none of these are things you can sell out individually. And just because you don't offer it as a security doesn't mean that you're going to be able to monetize it another way. So I think that's kind of the idea of utilization, the idea of being able to do something that you couldn't do before, to be able to leverage something that couldn't have been done before. I think that is the right mindset to think about securities, because you're not really losing out by not pledging that, because you couldn't do anything else with it to begin.
which kind of shows the creative side of venture debt, unlike venture equity, which is kind of quite a clear cut. I think with venture debt, you can be very creative in how you structure a deal, and what in a way it actually forces that all these deals become a very customized to every case or to every startup. So there is no kind of one size fit all in a sense. So I love that part. And thank you so much, Nathan, because I think you've covered it in the previous episodes we had, but now it's kind of sinking in, right? That it's due to this fact that we're trying to find new ways of security, or finding security, and making sure that the founder is not necessarily impacted, that this brings about the customization side of things. So I love that. Thank you so much, Nathan. So we are coming to an end to this series. So I think this is a great point, a great moment to say here to everybody that's looking at us today. We have 2 more episodes on the venture debt series to go. One that is dedicated to investors. So if you are looking into investing in venture debt, what do you expect from a venture debt fund? And another one that will kind of be crowdfunding or crowdsourcing, I would say. That's the problem of working in the investment side. Everything becomes funding. But crowdsourcing questions from the audience, and we kind of recap a recap session 2 sessions from now. So 2 weeks from now, you can start shooting us questions if you want that we want us to cover in that last session with Nathan and Sean from IMM Invest Global, and we'll be happy to answer them. And if you are looking to invest in a venture debt fund and just need some high-level thoughts on how does this work from an investor standpoint, stay tuned for next week where we kind of discuss this a little bit more. And we're happy to actually obviously take any questions you might have. Nathan, any last words before we kind of close today's series?
Yeah, Tarek, just kind of on the last announcement that you made, asking for the questions to all of you listening, guys. I would really encourage just to ask any and everything. There really are no stupid questions. I know this asset class is quite new to the region, and the mechanics are different. The idea of a loan, there are some fundamental mechanical differences of how the investment and the structure works as opposed to an equity investment. So I welcome any questions that you have, and I think some of the other areas related to venture that we didn't go too much deeply has to evolve around Sharia and Islamic principles. So there are also a number of a wealth of topics there of how we kind of structure debts in order to make it Sharia compliant. And to anyone who was kind of wondering and concerned about that, there are absolutely ways we can make it Sharia compliant. So that shouldn't be a deterrent in any way. And you don't need to worry about the mechanical side. That's all with us. So please feel free to ask any questions. We'll always be here for you.
Super. Love that last comment, Nathan. Remember, guys, you can obviously, if you missed any of these episodes that we've done with Nathan and Sean on venture debt, you can always go to our YouTube channel where you'll find an entire playlist just dedicated to venture debt. And obviously, you can always reach out to our website, Shorooq.com. Click on that content button right there, and you'll see a page full of our own blogs and our own Founders Crushing It series, and obviously other panels and speaking opportunities that Shorooq Partners and our own people have been part of. And there are a tremendous amount of knowledge there and expertise being shared. And obviously, feel free to throw any ideas you might have or you might want us to cover. And if you're a startup looking to raise venture debt or to raise venture equity, feel free to reach out to us through Shorooq.com. You can get in touch directly to our investment team through the Get Funded button. Click that button. The form only takes 5 minutes to fill. and it will be right in front of our investment team. Finally, don't forget to follow us at Shorooq Partners across our social media platforms. That's Instagram, LinkedIn, Twitter, and stay tuned for more. We're bringing in more series from the venture debt team, but also the venture equity team, from myself, Nathan, and the Shorooq Partners team. Thank you so much for tuning in. Have a great day.